Welcome to our deep dive. Today we're tackling the U.S. housing market, digging into the very latest data. We've gathered a whole stack of recent updates, different reports, research, and our goal is simple. Cut through the noise. We want to pull out the most important insights for you. Think of it as, well, your shortcut to really understanding where the market is right now. Not just the headlines, the actual facts, the trends, and maybe most importantly, the why behind it all. So what's the big picture from our sources? Overall, it feels like a stable market, but definitely showing clear signs of cooling down. Prices aren't really crashing nationally, but they are flattening out. Sales slowing down. And maybe the biggest news for some, inventory is actually improving finally. This whole shift seems largely driven by one major thing: high mortgage rates, the cost of borrowing. Let's unpack what the data is telling us.
Right. Diving straight into those executive summaries from the reports, the message is really consistent. The market's shifting gears. It's stable, like you said, but it's clearly moving into a cooler phase. That frantic pace we saw, it's gone.
Okay, so stable but cooling. Is there one particular number or trend that really jumps out from that high-level view?
I think it's the combination of prices flattening out nationally, even though we have a pretty strong job market, and you pair that with this significant jump we're seeing in inventory, it just signals that affordability, really driven by those high rates, is acting like a powerful brake on demand. It's kind of counteracting other positive economic signs.
Okay, let's get specific then. What are the key metrics actually saying right now? Let's look at the data from around, say, April, May 2025.
Yeah, let's start with the median home sale price. Nationally, as of April, it was sitting around $414,000. Now, the key thing here isn't just the number itself, it's the year-over-year change. It's only up about 1.8% nationally compared to last April. So effectively, prices are pretty much flat compared to a year ago. Yeah, they ticked up a bit from the winter lows, but that's just normal spring seasonality. The real story is that near-zero appreciation nationally.
Near zero nationally.
Yeah.
But you hear stories, are some places actually seeing prices drop?
Oh, absolutely. Well, the national gain is tiny. The sources are clear. Some markets that, boomed like crazy a couple of years back, they're seeing declines now. Phoenix and Austin get mentioned specifically. Year-over-year price dips. That contrast is really important. National averages can definitely hide what's happening locally. Big differences.
Right. And what about how fast homes are selling? Is that pace slowing down too?
Yes, generally homes are taking longer to sell compared to last year. The median days on market nationally in April was about 40 days. That's roughly 5 days slower than April 2024. Now, it did speed up from the deep winter months, which is typical spring activity. NAIR data showed median DOM at 29 days in April, down from 36 in March. But compared to last spring, it's a definite slowdown. Gives buyers a bit more breathing room.
Okay, and the inventory situation, the thing everyone's been waiting for. Are we finally seeing more homes listed?
This is probably the most encouraging data point for buyers right now.
Yeah.
Active listings. They've seen a really significant increase. Our sources point to roughly 1.96 million homes for sale in April. That's a big jump, about 16% year over year. And that's pushed the months of supply nationally up to somewhere between 3.0 and 4.4 months. Last spring, it was around 3.5 months.
16% jump. Wow. How does that compare historically? Where does that put us?
Well, inventory is now at its highest level in almost 5 years. It's getting closer to pre-pandemic levels. Now, a truly balanced market is often considered, 5-6 months of supply, so we're not there yet. But moving from those extreme lows of 1-2 months during the frenzy to this 3-4 month range, that's a noticeable improvement for buyers.
Okay, so more homes listed, they're taking a bit longer to sell. How's that affecting the number of actual closed sales?
Yeah, the pace of existing home sales is, pretty slow. It's running at about 4.0 million seasonally adjusted annual rate. That's SARE. It basically smooths things out to show the underlying trend. That 4 million rate in April, down about 2% from a year ago. It's one of the slowest rates we've seen in years. The actual number of homes closed in April was around 441,000. That's about 3% fewer than last April.
Existing sales sluggish, but is there any bright spot in sales activity according to the sources?
Interestingly, yeah, new home sales seem to be holding up better. Around 743,000 new single-family homes sold in April on that SARE basis. That's up 3.3% year over year and a pretty solid 10.9% jump just from March. So builders are clearly finding ways to move their inventory, which we can definitely get into more detail on.
That's a key difference then, new builds versus resale. What about looking ahead? Are people signing contracts? What do pending sales tell us?
Pending sales look pretty subdued. The National Association of Realtors Index, the Pending Home Sales Index, actually fell 6.3% from March, and it was 2.5% lower than a year earlier. Other data, like from Redfin, also shows buyer demand is slightly down year over year. So all that suggests we probably shouldn't expect a big surge in sales this summer. It looks like a quieter season ahead.
Okay, so summing up the snapshot, what's the main takeaway for you, the listener, from all these numbers?
I think the essential insight is that the market has just fundamentally shifted. That intense, multiple offer bidding war environment from a couple of years ago, that's largely gone. There's more supply than we've seen in a long time. Homes are sitting a bit longer. Sales volume is low. But crucially, nationally, prices aren't collapsing. They're just stagnating. And that creates a very different playing field for anyone thinking about buying or selling right now.
That makes a lot of sense. Now, you mentioned the high cost of borrowing as the key driver. Let's dig into why these changes are happening. What are the sources saying is the primary force behind this cooling?
The data is really clear on this. It overwhelmingly points to high mortgage rates as the main factor. Our sources show the 30-year fixed rate was sitting around 6.8% to 6.9% in late May 2025.
Right. And just to underline how big a deal that is, that rate is more than double what we saw just a few years back in 2021 when rates were down below 3.5%.
Exactly. And while rates are maybe a little below their absolute peak from about a year ago, they touched just over 7%, then they're still historically quite high compared to the last decade or so. And that has just massive implications for affordability.
How does that high rate hit affordability so hard?
It's the major squeeze factor. You take those high rates, combine them with home prices that, okay, maybe they're flat year over year, but they're still way up from historical norms. The result, near record monthly mortgage payments. The median principal and interest payment was around $2,848 in April nationally. That was just like $8 below the all-time wrecking high. And simply put, average incomes just haven't kept up with that surge in housing costs. So affordability is incredibly stretched, especially for first-time buyers trying to get in.
So how are potential buyers reacting to this affordability crunch? What are they doing?
Well, a lot of them are either priced out completely or they're just approaching the market very cautiously. Some are trying to compensate, maybe making larger down payments if they have the savings. Others are looking at different loan types like ARMs, adjustable rate mortgages, where you get a lower initial rate that adjusts later. Or frankly, many are just delaying their plans altogether, hoping for rates or prices to ease up down the road. That high monthly payment is the main reason demand has cooled off.
And then there's that related impact on sellers, the lock-in effect, right?
That is such a crucial piece of this whole puzzle, especially when we talk about resale inventory. Think about it.
Yeah.
Existing homeowners who bought or refinanced when rates were, say, 3%, maybe 4%, they are really reluctant to sell. Moving usually means trading that super low rate for a new mortgage, potentially twice as high. That dramatically increases their monthly housing cost, even if the house price isn't that different. So that hesitation keeps a lid on the supply of existing homes coming onto the market.
Okay, that explains the tight resale inventory. But didn't you say total inventory is up quite a bit? So where's that new supply coming from if current owners aren't moving as much?
Right, that's where the market dynamic really shifts. With fewer resale options available, newly built homes are stepping in to fill that gap. According to the sources, roughly one-third, like 33% of single-family homes for sale nationally are new construction right now. That's about double the share compared to before the pandemic. Builders really ramped up production during the boom, and now they're a major source of available homes.
And are builders having to, work harder to get buyers in the door given the high rate?
Oh, absolutely. The data shows builders are being very active with incentives. Nearly 61% of builders offered some kind of sales incentive in April. That's even a little more than a year ago. These often include things like paying closing costs, adding upgrades, or, and this is a big one, offering mortgage rate buydowns. That's where the builder pays a fee to lower the buyer's interest rate, usually for the first year or two. It makes those initial monthly payments much more manageable.
So builders are definitely competing. What about overall buyer demand and competition for listings? Sounds like a very different picture than 2 years ago.
It's like night and day. Honestly, that bidding war frenzy, it subsided dramatically. About 30% of homes sold above their list price in April. That's down from around 33% a year ago. And the average sale to list price ratio, it's now 99.2%. That means the typical home is selling for just under the asking price, not way over it. That's a clear signal of power shifting back towards buyers.
And are we seeing more homeowners having to drop their price after listing?
Definitely. Price drops are much more common now. Nearly 20% of listings had a price reduction in April. That's up from about 15% last spring. If a home is overpriced, it tends to just sit there. The sources noted that 44% of listings in April had been on the market for 60 days or more. That's the highest share for April since way back in 2020. And this also means things like contingencies, inspections, appraisals, they're back. Buyers can ask for them. And sellers are often more willing to offer concessions, especially if their home has been listed for a while.
So boiling this all down,
Yeah.
how does this translate into something actionable or relevant for you listening right now?
I think the core takeaway is that the high cost of borrowing is really the dominant force shaping everything. It's not just about the sticker price anymore. That monthly payment is king. It's limiting who can buy, yeah, but it's also forcing buyers to get creative with financing. And at the same time, it's slowing the market's pace significantly. And crucially, it's giving buyers leverage, real leverage to negotiate on price and terms in a way they just haven't had for years.
That makes sense. Now, national averages, overall trends, they can hide a lot, can't they? Let's dive a bit deeper. How do things look different depending on the price point or the specific location?
That's so critical because the market you experience is intensely local. Well, yeah, the national sale-to-list ratio is just under 100%, showing sellers get close to asking. The fact that price reductions are so widespread tells you that initial pricing is more important than ever. Homes aren't just automatically selling over asking anymore. Not by a long shot.
How are the different price segments doing? Like, is the entry-level market still super hot, or has that changed?
It's a bit nuanced across the different price tiers. The entry level, the most affordable segment, it still has pretty strong demand. Part of that's demographics, right? Millennials hitting that peak first-time buyer age.
Yeah.
Inventory there is the tightest. One source mentioned around 2.5 months supply for that lowest tier. But affordability is the major bottleneck. High rates just cap how much buyers can borrow. So that limits price growth, even with strong demand and low supply.
Okay. What about the middle of the market, around that national median price?
Mid-market, yeah. That's where a lot of move-up buyers would typically operate. It's seeing more moderate price gains. Non-luxury homes were up about 4.1% year over year. But this tier is really hit hard by that lock-in effect we talked about. Lots of potential sellers there are anchored by their current low rates. And buyers in this middle segment, they're also becoming more selective, more price sensitive, pickier.
And the luxury market, is that feeling the pinch with broader economic uncertainty, maybe?
Yes, the luxury segment is definitely showing more visible signs of cooling, according to the sources. High net worth buyers, they tend to be more discretionary shoppers, maybe more sensitive to stock market swings or economic forecasts. Pending sales of luxury homes were down almost 10% year over year in April. That's actually a decade low for that month. And while the typical luxury sale price might look like it's up in some reports, one source said plus 6.5% YY, the analysis suggests that's probably due to a shift in the mix of homes selling. Like maybe fewer lower-end luxury homes are selling, pulling the average up, rather than broad appreciation across the board. In fact, some high-profile luxury markets like San Francisco, they saw actual price declines year over year, about 2.2% in Q1. Luxury buyers can afford to wait, and it seems like many are doing just that. So those flat national prices are really a mix, constrained entry-level, kind of moderate mid-market, and a softening luxury end. That's a key distinction. And you mentioned regional differences are huge. Which markets are still seeing strong price growth, bucking the national trend? This is where local economies and supply really shine through. Generally, the Northeast and the Midwest are showing stronger price growth than the national average. The Northeast saw about plus 6.3% year-over-year median price growth. Specific cities like Detroit, up 12.5%. Cincinnati, up 10%. Certain parts of Florida, especially in luxury, are also defying the trend. Miami Beach saw a huge 25% year-over-year surge. West Palm Beach luxury jumped almost 26%, and some mid-Atlantic markets like Baltimore were surprisingly hot, up 22% year-over-year.
Wow, Baltimore up 22%. That seems like a massive outlier compared to the flat national picture. What do the sources say causes that?
Yeah, the reports often link these kinds of surges to specific local economic factors, maybe tighter local inventory that's unique to that area, or even relative affordability compared to nearby major cities, making them attractive even with higher rates.
And on the other side, which markets are cooling down most noticeably?
The ones cooling fastest are often those that saw the absolute biggest booms back in 2021, 2022, or maybe areas impacted by recent tech layoffs. Phoenix and Austin, like we said, are seeing year-over-year price declines. Dallas, Sacramento, Portland, Nashville, Orlando, also seeing prices flatten out or dip slightly. And San Francisco luxury prices falling is also pretty notable. These are areas where inventory increases have been more pronounced and buyers have pulled back more significantly.
So the relevance for you, the listener, couldn't be clearer. The housing market is definitely not one single thing.
Exactly. The experience you have will depend so much on where you're looking and the specific price range. Local factors just matter immensely. National data is just context. You really need to zoom into your specific metro and even neighborhood.
Let's shift gears slightly then and talk more about the money side, beyond just house prices. What's the latest on lending? How are people financing these homes?
Well, mortgage rates are still the main character in this story. They've been bouncing around mostly in that 6% to 7% range. Lately, hovering around 6.8, 6.9%. Economic news, especially anything about inflation, keeps them pretty volatile. Most forecasts and the sources seem to expect rates will probably stay somewhere in that 6.5% to 7% band for the rest of 2025.
And like we discussed, that high cost is still stretching affordability really thin for buyers, right?
Oh, absolutely. That burden of the high monthly payment, it's the biggest hurdle for so many potential buyers right now.
Has the actual availability of mortgages changed? Are lenders getting tighter or looser with their standards?
Lenders are still cautious, for sure, but the sources show a slight easing compared to maybe a year ago. There's something called the Mortgage Credit Availability Index, MCAI. It basically measures how easy it is to get a mortgage. That index actually rose to a 2-year high back in March 2025. So it's up, meaning lenders are slightly more willing to lend.
Right.
But standards are still much, much stricter than they were before 2020. You still need good credit, solid income proof, all that.
And are government-backed loans playing a bigger part in this environment?
Yes, definitely. Programs like FHA and VA loans are really vital pathways for a lot of buyers, especially first-timers. And that recent FHA premium cut is helping a bit too, making those loans slightly more affordable. It saves eligible borrowers around $800 a year, which, helps.
Given these high rates, how is buyer behavior changing on the financing front? Are they exploring different options more?
Well, the high rates definitely reinforce that seller lock-in effect, which limits the resale options. For buyers, particularly first-timers, it's absolutely pushing them to look at alternative strategies. We're seeing more use of those seller-paid rate buydowns we mentioned, especially from builders, to ease the initial payments. Adjustable rate mortgages, ARMs, are a bit more popular, especially for buyers who think rates might fall later and they can refinance. And there's more talk, though maybe less action yet, around assumable loans. That's where a buyer could potentially take over the seller's existing low-rate FHA or VA loan. Tricky, but possible.
And are buyers really sensitive to even small changes in rates right now?
Extremely sensitive. The sources really highlight this. Even like a 0.5% drop in mortgage rates can noticeably boost buyer activity because it makes such a significant difference in that all-important monthly payment. So yeah, lots of buyers are watching rates like hawks for any favorable dip.
So for you, navigating this financial side really requires careful planning and maybe some creativity.
Exactly. Understanding all the different loan products, shopping around aggressively for the best rates and terms, and being aware of potential help, like down payment assistance programs or those builder and seller incentives. It's all crucial to figuring out what's truly affordable and how to actually make a deal work in this high-rate world.
Let's zoom out now and look at the bigger picture, the broader economic forces. What's the connection between the overall economy and this housing data we're seeing?
Yeah, the U.S. economy is presenting kind of a paradox for housing right now. On one hand, the job market is still remarkably strong. Low unemployment, around 3.7%, millions of jobs being added. Normally, that kind of job strength would fuel really robust housing demand and sales.
But as we've seen, actual home sales volume is pretty low compared to before the pandemic.
Exactly. Home sales are running at only about 75% of pre-pandemic levels, despite that strong job market. And this tension really points to significant pent-up demand. There are people who are employed who want to buy, but they're being held back, primarily by that affordability issue, high rates, elevated prices. Real incomes are only just starting to catch up with all the inflation we've had, so that hasn't fully eased the pressure yet either.
How are local economic shifts playing into this?
Oh, local factors are definitely reinforcing those regional differences we talked about. You see tech sector layoffs clearly cooling demand in places like San Francisco, Seattle, Austin. But then conversely, you have corporate relocations, growth in manufacturing, energy, healthcare. That's boosting demand in parts of Arizona, Ohio, the Southeast. And remote work is still sustaining demand in suburbs and Sunbelt areas that maybe weren't major job centers before.
And any big policy or seasonal factors shaping things?
Policy-wise, the Federal Reserve is the big one. Their decisions on interest rates directly influence mortgage costs. That's the main lever. You also have state and local zoning reforms trying to increase supply, allowing ADUs, duplexes, things like that. But that's a slow burn, incremental change. Federal ideas like first-time buyer tax credits get talked about, but nothing's actually enacted right now. And seasonality. It's definitely back to playing a more normal role. We saw a slow winter. The spring uptick was kind of muted, busy, but not booming, was a phrase I saw used to describe spring 2025. So we could probably expect a summer plateau or cool down, then the usual autumn slowdown.
Okay, putting all these economic signals and factors together, what's the forecast look like from the sources for the rest of this year?
For the short term, say the next few months through summer 2025, the general outlook is for the market to stay pretty subdued, but stable. Inventory is expected to keep creeping up slowly. Buyer activity might level off or even soften a bit after the main spring season. Prices will likely flatten out or maybe see small seasonal dips in some areas. Probably don't expect a big summer price spike. And rates, generally expected to hover near where they are now, which means buyers will likely keep that increased negotiating power we've been discussing.
And looking a bit further out, say, towards the end of 2025.
The midterm outlook really hinges on the Fed. If inflation cools down consistently over the next few months, there's a chance the Fed could start cutting rates later in 2025. If that happens, mortgage rates could maybe dip into the low 6% range, perhaps even high 5s. And that would likely re-energize buyer demand going into 2026. But if inflation stays stubborn, rates probably stay high and the market stays sluggish. There's also the wild card of a mild recession. That could lower rates, but it would also likely increase unemployment, creating kind of a mixed bag for housing.
What's the sort of baseline prediction most sources seem to agree on for prices and sales by year-end?
The baseline consensus seems pretty cautious. Most sources are expecting home prices to be flat to maybe slightly down year over year by the fourth quarter of 2025. Redfin, for instance, put out a forecast for about a negative 1% year-over-year dip nationally. Inventory is expected to keep rising, maybe getting closer to those 2018-2019 norms. And sales volume, likely to stay low, possibly the lowest in about a decade, mostly because of that lock-in effect limiting supply and affordability limiting demand.
Are there any big macro wildcards that could really shift this forecast?
Oh, for sure. An unexpected inflation flare-up could push rates back over 7%, which would really dampen demand further. A sharper economic slowdown or recession could potentially drop rates below 5.5%, but that would come with job losses, which isn't great for housing either. Geopolitics, global financial stuff, always factors. Underlying demographics, though, especially millennials in their prime home buying years, that provides a solid base of long-term demand. It's not going away, it's just being delayed by current costs. And importantly, supply is still constrained overall. We're very unlikely to see a massive glut of homes like in 2008. The risks this time are mostly on the demand side being held back by cost.
So for you, the listener, understanding these forecasts really means recognizing that the market's future path heavily depends on those big economic shifts, especially interest rates.
That's the key insight, yeah. Your ability to buy, sell, or invest effectively could really depend on how these broader economic and policy trends play out, and also how resilient your specific local market is to those national forces.
Okay, we have covered a ton of ground. From the current data, the drivers, regional differences, financing, the outlook, let's try to boil this down into some actionable insights. Based on the advice in these sources, what should potential sellers be thinking about right now?
All right, based on agent advice and the sources, the number one takeaway for sellers is time is generally not on your side like it was the past few years. This is a cooling market. Price your home correctly, right from the start. Use recent comparable sales, not the peak prices from 2022. The data shows overpriced listings. Just sit there, remember, that 44% on market over 60 days in April. If you're not getting serious interest or offers in the first couple of weeks, be ready to adjust your price proactively. Don't wait too long. Presentation is also huge now. Staging, great photos, curb appeal, they matter when buyers have more choices. And be prepared to consider incentives, maybe offering to cover some closing costs or contributing to a buyer's rate buy-down. Honestly, if you need to sell, doing it sooner might be better, as forecasts suggest prices could be flat or even slightly lower by year-end. And maybe most importantly, set realistic expectations. Be prepared for negotiations. Buyers are back to asking for repairs, contingencies, concessions. It's normal again.
That's really practical advice for sellers. What about for potential buyers? The picture sounds, well, more encouraging for them.
It definitely is. Buyers, you have leverage now. Leverage you haven't had in years, so use it, negotiate. On price, yes, but also on terms. Don't feel pressured into waiving important contingencies like inspections or appraisals. Those are standard again. Shop around aggressively for your mortgage. Explore different loan options, buy-downs, ARMs, maybe down payment assistance programs in your area. Use the market data. Look at homes with price drops or ones that have been sitting longer. Use that to inform your offer strategy. Asking for seller concessions is totally back on the table. Ask for help with closing costs or a rate buy-down. Don't be shy. Get fully pre-approved first so you know your real budget. Be patient, but also persistent. The core advice seems to be, if you find a home that really meets your needs and you can genuinely afford the monthly payment at the current rate, it might be okay to buy. You can always hope to refinance later if rates drop, but you can't go back in time and buy that specific house. Your negotiating power is the best it's been in a long, long time.
And what about for investors looking at this market? What's the advice there?
Well, high rates have definitely thinned out some competition, both from owner-occupants and maybe less experienced investors. So that could create opportunities if you're disciplined. The sources advise focusing on rental yield and long-term value. Rents are still climbing in many markets, which makes single-family rentals look pretty attractive, especially in areas with good job growth. Look towards Sunbelt and Midwest markets for potentially solid cash flow. Some reports mention cap rates, that's the return measure investors use, potentially in the 5–7% range there. Be a bit more cautious maybe with large multifamily apartments. They're seeing rising vacancy rates. One source I cited 8.2% in Q1 2025 and slower rent growth. So underwrite those deals conservatively. Negotiate hard. You might be able to get 5%, maybe even 10% below asking, or get seller concessions, but absolutely factor in those high financing costs. They really impact your cash flow calculations. Check local rules on rentals, taxes, all that. The advice boils down to be nimble, keep cash reserves, maybe diversify, and focus on the fundamentals. Sustainable cash flow, a reasonable purchase price, and think long term.
Why are these specific actionable insights so important for you, our listener, right now?
Because it doesn't matter if you're thinking of buying, selling, or investing. Understanding these current market dynamics and knowing which strategies are actually effective today, that gives you the tools to make smart, data-driven decisions. This just isn't the market from 2 years ago. Applying those old strategies won't work now. Knowing these insights helps you navigate this different environment effectively.
So there you have it. We've done a deep dive into the U.S. housing market based on this latest stack of sources, the clear picture, a market that's definitely transitioning away from that recent frenzy. It's finding its footing in a more balanced, yes, but also slower environment. And it's largely being dictated by that significantly higher cost of borrowing. Inventory is improving, which gives buyers more choice and more power to negotiate. But affordability, that remains a huge challenge for many.
Yeah, understanding these specific nuances, the actual numbers we talked about, those stark regional differences, the financing realities, and the actionable strategies for buyers and sellers, that is absolutely key to making smart choices in this evolving market. It really is about adapting to the current reality, not wishing for the market of the past.
And maybe here's a final thought to leave you with, something we saw reflected in the sources we looked at. They consistently point to this idea of significant pent-up buyer demand just waiting on the sidelines, held back mainly by those high interest rates. So, if or perhaps when those rates eventually fall more meaningfully, what could that unleashed demand mean? What could it do to competition and prices down the road? And how might preparing for that potential future shift impact your long-term housing plans? Something to think about.